Hi, this is Todd with Integrity Investment Advisors. Here's our Q2 update for 2025. Several important items I want to cover. Markets are always looking forward. The economy and jobs, are they getting better or worse? The goal for clients and everybody should really be to have compounding working for you for decades, net of all fees, net of taxes, and net of inflation. And solid companies tend to grow their earnings over time. Hope you enjoyed the video. So here's a key slide we made back in April where the markets were going through a little bit of chaos because of the tariffs and everybody was worried about recessions and how bad these tariffs were going to be. And we laid this out probabilistically about how to think of tariffs. And we knew there was a chance that this could get resolved quickly in option 1 and option 2 here. And that seems to be what's happening. The markets are more comfortable with it. It looks like it's going to get resolved for most of our major trading partners. And it looks like it's just going to work out. And the markets are moving on and looking forward. It seems like they're viewing it as a VAT tax for around 15% for consumers. And that's very consistent with the rest of the world. So for now, it seems like it's not going to take a long time. It doesn't seem like we're going to have an imminent recession because of the tariffs. And people are just sort of moving forward. And here's what happened. So markets freaked out a little bit with the tariffs. I think it was poorly organized. We hit a low back in April and have recovered to all-time highs, up 32% from the lows. And markets are up, even a little bit more here in July and August. And it's important to know that the markets tend to do very well after sharp drawdowns. And here's a slide that talks about that back from 2009. 2016, 2018 was a very strong pull down. Obviously COVID and a couple other instances in 2022 and then this year in 2025. So looking forward 1 year, returns tend to be pretty good. Looking forward 3 years, returns tend to be even better. So we'll see how this turns out. But since the lows, the markets are up 25% at this point in time. And it's important to realize that annualized returns have been pretty good for decades. I love this slide. Very good returns, very good compounding. Obviously, we had the lost decade here from very high elevations at the end of 2000. But other than that, returns have been good. And here's a slide that talks about bonds. So for us, bonds are for liability matching and for about 5 to 7 years worth of cash flow needs. They typically offer very low real returns, net of fees, net of taxes, net of inflation. And you can see that in the 2020s, they've had really bad returns. And we're probably moving back to more of a period like the 40s, through the 70s, more stable, but very low real returns. And again, so we just want this for liability matching and safety in the portfolios. And we want equities and alternatives to drive longer term growth for our clients. And here's a great example today where we are. The forward implied yield on bonds is about 4.7%. So that sounds okay, except for net of inflation, minus 3% inflation, you're at a net return of about 1.7%. And it's less if you hold bonds in a taxable account. So even though a 4% yield on Flourish or a high yield savings account sounds okay, you don't want to hold too much in cash. Less 33% taxes gets you down to 2.68% and inflation at 3%. So you're really just treading water with any cash in taxable accounts. And even less if you live in a high tax state like California. All right, people sometimes ask us about the debt and isn't the debt going to be a problem? Yes, it is, but I think we're working our way through that. Seems to be the plan. I don't think we're going to go into austerity where we actually cut a ton of defense and Social Security and things like that. The public won't stand for it. Politicians won't stand for it. So our choices are to really just grow our way out of it with productivity and also have some mild inflation to go with that, which debases our wealth and we can inflate our way out of it. So that seems to be the preferred method as of right now. So I mentioned, and you pause any of these slides, but markets are very expensive relative to the last 10, 20, and even 30 years. You can see this in the percentiles over 10 and 30 years. You can also see where we are relative to history over the last 20 years. So pretty expensive, obviously, for technology and the S&P 500. Equal weight, which I'll show you in a slide here coming up, is a little bit more fairly valued, but we're expensive. So we would expect lower returns moving forward, and we're planning for that. Here's another thing we're tracking, and this is the amount of speculation out there in the marketplace. This is for meme stocks, crypto, unprofitable companies, people chasing high growth companies, people maybe gambling with some of their money that they would have used for housing You can see we're at some pretty high levels, not as high as February 2021 or 2000, but still pretty high. So we want to keep watching this. Here's a great chart. Our market's expensive. If you look at it on an equal weight basis, not so much. We're a little bit above average over the last 6 years. And I think if we can get AI and productivity to help out the bottom 493 companies, we might see the bull market sort of spread out to those companies. Here's another question we've been getting from clients. Is it okay to keep buying at all-time highs? The answer is yes. Actually, all-time highs, surprisingly, have a little bit better returns when you're buying at all-time highs. You can see that right here. The green, a little bit better on the 1 year, 2 year, 3 year, and even 5 year basis. This is from 1988 through 2024. Keep dollar cost averaging in and letting your money grow for you over time. Here's another example of some questions we're getting. Concentration in the U.S. marketplace and around the globe is pretty high with some mega cap companies. In the U.S., the top 10 companies account for 40% of the market cap and 30% of the profits. So that's much higher and much better than the 2000, where they weren't nearly that profitable. And you can see they've been crushing it over the last couple quarters, but the bottom 493 are going to be catching up here in 2025 and 2026 as we move forward. Clients have been asking about individual stocks. Picking individual stocks is brutally hard. The odds of having a 30%, 40%, or even 50% drawdown is very high over a 1, 3, and 5 year period. In our opinion, it's much better to own ETFs and indexes. Here's another example of that. Over the last 12 months, only 20% of S&P 500 companies have actually beaten the index. And you can see here, even the top 7, Mag 7, only 3 of the 7 have beaten the index, year to date from that standpoint. And same for last year, only 3 of the 7. Well, actually probably more than that last year. But it's very hard to own individual stocks. Here's another slide. The U.S. has actually crushed the rest of the world, international and emerging markets over the last 17 years. Will this continue? We think it can. We certainly own international and emerging markets, but a lot of the innovation is coming from the U.S. Here's an example of stay invested. If you just miss, since 2015, if you got an average return in the S&P 500 of 12% per year, if you miss just the 10 best days every single year, you would have a negative return, negative 10% over that same period. That's a massive difference. So we want to stay invested in equities. It's impossible to time the market. We need to just stay invested. Here's a slide that talks about international. Much of the S&P 500 sales come from international markets. So you can see 28% of the sales come from international. And technology is leading that at 56%. So even when we just own a lot of S&P 500 companies, we own a lot of international revenue and sales that comes from that. Here's a slide on the differences, key differences between international and U.S. stocks. Saying that international stocks are cheap is like comparing apples and oranges. They have very different sector compositions, and they've changed a lot over time. So this shows 2005 versus 2025 or 20-year period and the weightings. So if you look at the U.S. has a total of 42.5% in technology and communication services. The international only has 15.2% in those same buckets. So a lot less innovation, more regulation outside the U.S., lower return on investment. And this is one of the reasons why we own international, but we don't want to own too much of it. And here's a slide that sort of talks through that. Basically, if you're buying the U.S. versus Europe, you're overweight industrials and financials, you're underweight technology and communication services. And this sort of blew me away. Over the past 50 years, the U.S. has created from scratch 241 companies with a market cap more than $10 billion. Over that same time period, Europe has only created 14. So we want to keep this in mind. We want to own great companies over long periods of time that could grow their revenue, grow their earnings, and help us compound over long periods. So thank you for watching the video. Please like and share. If you're a current client and want to talk about your portfolio, please book a meeting with me. If you're a prospect and want to talk about becoming a client, please book a meeting. Thank you, and hope you enjoy summer.